This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're now going to go through chapter 14 of the free lecture notes for paper P2, and you'll see it's headed up Discounted Cash Flow Further Aspects. And as you'll see, there are three things, as you'll find out anyway, there are three things in this chapter to involve calculations, something called capital rationing and something called replacement. And they're both quite good fun, I think you'll enjoy them. The third doesn't involve calculations in this paper, but is discussion about something called real options. So I will break the lecture up, even though each bit shouldn't take very long, but there are three distinct things we need to look at. And the first is capital rationing. And as always, rather than talk and talk, I'd rather use an exercise to explain what the problem is here and how we approach it. So could you turn straight to exercise 1 on the second page? It says a company has the following 4 projects available, A, B, C, D. And just talking down one of them, project A has an outflow of 500. It then gives an inflow of 221 a year for 3 years. The net present value is 10%, and although, of course, you're more than capable, I hope by now, of calculating the NPV, to save time and quite possibly in the exam, you're given the NPV. The net present value at 10% for A is 50. And similarly, you've got the cash flows, the NPV for the other 3. And those are correct. Don't waste your time checking me. But there we are, with 4 projects. And before I look at the question, suppose I said to you, which of those, what will you do? You've got 4 projects available to you. What are you going to do? Now, most people tend to say, oh, you'll do project B, because it gives the highest net present value. And no, that's not the answer. Certainly, if you were only allowed to do one of them, then fine, you do project B. It gives the highest NPV, the highest net return. But I never said you could only do one of them. If you've 4 projects available, you'll do every project that gives a positive NPV. And so, but the answer to part A, I've yet to explain what I mean by capital rationing, but if you were offered 4 projects with no restrictions on you, you will do all 4, or at least you'll do every project where the NPV is positive. However, the real problem is part B. It says capital is restricted to 1,600 at time 0. Now that is what we mean by capital rationing. Capital rationing simply means for some reason there's a limited amount of capital available. And so part A, where there was no limit to get as much capital as we want, I repeat, you will do all 4 projects because they're all positive. Part B, though, if we've only got 1,600 available, well, we want to do all 4, but to do all 4, at time 0, A needs 500, B needs 600, C needs 300, D needs 400. The total you'd need would be 11, 14, you'd need 1,800. And we haven't got enough, we've only got 1,600. So we can't do all 4 projects. The question is, we want to do them all, they're all positive, but what will we do to make the best use of the 1,800 we've got? The other bit about part B, though, it says the projects are divisible. Now, what that means is And it may be a bit unrealistic in real life, but divisible means, firstly, we can do fractions of a project. So what I mean by that is project A. If we want, we can do half of project A or 20% of project A. We can do any proportion of project A. But it's a maximum of 100% of each. I don't know, I said, I think in most cases that's perhaps unrealistic in real life. You know, you either do a machine or you don't do it. I'm not sure about doing half a machine. But divisible means you can do fractions, 10%, 20%, 80%. Although, as I've said, the most you can do is 100% of each project. So you can't do 2 A's. At most, it's 1 A. We also assume that if, for instance, we did end up doing half of A, we assume it would be half the cost and only 250. We assume it would give half the returns. And if it is half the cost and half the returns, it would generate half the net present value. Which again, I think is unrealistic. Even if you can do half a project, I don't think it necessarily means you'd get half the returns. But anyway, that's what divisibility is. And on that basis, how would we best invest that 1,600? And the approach we use is in fact something you should have seen in paper P1, where we did it for slightly different reasons. But I think this should be logical. What we do, A, B, C, D, we say, well, what's the net present value? A is 50, B is 57, 36, 50. And what's limited? Well, it's the capital available at time 0 that's limited. So the investment required, A needs 500, B needs 600, 300, 400. And we calculate the net present value per dollar invested. So see what I mean? A requires 500 to generate an NPV of 50. And we say, okay, for every dollar that we invest in A, it's 50 on 500. We earn 10 cents for every dollar invested. And remember, we can do fractions. So I can invest just $1. I can invest $100, $200, $300. But for every dollar we invest in A, we'll generate an NPV of 10 cents. Similarly, B, it gives 57 for an investment of 600. Which is 9.5 cents per dollar. C gives 36 on an investment of 300, which is 12 cents a dollar. And D, 50 on 400, is 12.5 cents per dollar. Well, we want to get the best NPV we can for the money available. So the best investment for us is D. It'll earn 12.5 cents for every dollar. Second best is C at 12 cents a dollar. Third best is A. Fourth best is B. And incidentally, the NPV per dollar invested we call the profitability index. Well, now we can decide how to invest our money. Remember, with how much? 1,600 available. D is the best, and so we'll invest as much as we can in D. But remember, we can't do more than 100%. So the maximum we can invest in D, we'll invest in all of it. The maximum we can invest, therefore, is 400. And the NPV we'll generate is 50. Well, we had 1,600 available, so we've still 1,200 left. We can't do more of D, so go to the next best, which was C. C needs 300. We'll have plenty of money. We'll invest in all of C. Require 300. And the NPV will generate 36. So far we've invested 700. And of course we can't do more of C. We're limited to 100% of each project. Well, we have 1,600, so I have still plenty left. Go to the next best, which is A. That requires 500. We've still got 900 left. So again, we'll do 100% of A. Another 500, and the NPV we'll generate is 50. And I think you can see what's happening. We go down the line. We've still got 400 left. The next best is B. But here, of course, is where we're limited. We've only 400 left out of the total. B requires 600. And so we'll do 4/6 of B. And what NPV will we generate? Well, it can be 4/6 of the total, or remember, it's 9.5 cents per dollar invested, which is 38. And there we are. We've invested our total of 1,600. The exercise actually only said, what should our decision be? Well, there you are, all of D, all of C, all of A, and a fraction of B. If you did say, as is quite likely, what will be the maximum, the total NPV? The total NPV, 86, 136, 136, I think 174. And that is the maximum NPV that we could generate. Try any other way, the NPV will be lower. So, that's nice. However, just one more bit, part C. Part C says, again, capital is restricted to 1,600, but this time the projects are indivisible, they're not divisible. And that means project A, you either do all of it or none of it. We can't do fractions. And so for part C, the solution we've got there won't work. We can't do 4/6 of B. It has to be all or nothing. Well, here there is no quick way. It doesn't take long, but the only way we can do it is consider the alternatives. For instance, we can do A and B and C, because that would need investment of 500, 600, 300. The total investment would be 1,400. But we'd only have 200 left, so we couldn't then do D. Alternatively, you could do A, B and D. That would need 500, 600 and 400. Can we do that? Yeah, that needs 1,500. Fine, we've enough, but we can't do C as well. So I think without me writing all the numbers down, you can see that we can afford to do any 3 of these. We just can't do all 4. So it'll be A, B, C, A, B, D, or A, C, D, or B, C, D. Have I got them all there? A, B, C, A, B, D, A, C, D, B, C, D. Yes. In fact, I said I wouldn't write them down, but I will. That'll be 500, 300, 400, total 13, 1200. We can afford that, but we couldn't afford to do B as well. And finally, 600, 300, 400. That'll be 1300, but again, we couldn't afford to do A as well. So it's one of those. Well, there are 4 options, and we want whichever's best of those 4. And so we just need to work out what the NPV would be in each case. The NPV, if we did A, B and C, A gives 50, B gives 57, C gives 36. So the total NPV, if we did those 3, it'd be 143. If we did A, B, D, 50 from A, 57 from B, 50 from D, the total is 157. ACD, 50, 36, 50, a total of 136. Or finally, BCD, 57, 36, 50. I think I'm right, is 143. So there are 4 choices. We want maximum NPV, so it's whichever's the highest, which in this case is that. We'll invest in A, B and D in full, and we'll get the maximum NPV of 157. Which of course is less than in part B. Of course it is. Because here we're not able to invest it all in everything, you know. But that's the maximum we can get. Now, although there's our answer finished, I'll just make one little point. Some people get a bit worried because we did have 1600 available. I hope you've agreed with me that because of this restriction, we decided to do A, B and D, and we've only been investing 1500. What's going to happen to the other 100? Well, the answer is quite simple. The point is, the 600 available, one way or another, we will be borrowing it. What it really means is, we can borrow up to 1600. And so if I only need 1500, not much point in borrowing the other 100. What on earth do you want to borrow money for if there's nothing you can do with it? So the other 100 you won't borrow. You know, there's no point in paying interest on money borrowed that you can't invest. Even if you had cash sat in the bank, remember strictly, any cash in the bank belongs to our shareholders. Effectively, we are borrowing it from shareholders. And if there's nowhere we can invest it, we'll give it back to the shareholders. So there's no problem. Doesn't affect our answer at all. The most we can get is 1600. If we don't need it all, we won't borrow it. I will finish on one final thing, which isn't mentioned in the notes, I don't think. No, but just to be safe. There are actually 2 reasons why capital might be rationed, why there's a limit. The first reason is in fact the most obvious. It's called hard capital rationing. Hard capital rationing is when lenders will not lend anymore. Now that's the most obvious, I think you'd agree. If our lenders will only lend us 1600 maximum, then of course we've got rationing, and that's called hard capital rationing. However, there's another reason, which is in fact probably more common, called soft capital rationing. Before I write down what it is, let me explain first, and then I'll put it in words. about yourself. If you're working and earning a salary, and you decide you want to borrow money to buy a car, well, if you're earning a decent salary, if you've got a good job, I'm sure the bank will lend you money. Let's suppose they're prepared to lend you 20,000. It doesn't automatically mean that you'll say, right, I'll borrow 20,000 to buy a car for 20,000. Not at all. Because you know if you borrow 20,000, you're going to have to make repayments and pay the interest and everything else. And so the bank tells you they'll lend you 20, and you might go and you might say, oh, well, I'll just borrow 12,000. I only want, a smaller car. What I'm getting at is we don't automatically borrow everything we can. We find out how much we're able to borrow, but sensibly. Very, very often you'll borrow less than you're actually able to. You've set your own limit. And so do companies. Just because they might be able to borrow 1,600 doesn't mean they automatically will. They'll decide how much they're prepared to borrow. So soft capital rationing is when the company fixes its own limit, even though they could borrow more. So, I hope that makes sense there. It doesn't affect the numbers at all. Doesn't matter why we're limited in this question to 1,600. The decisions are the same. But just be aware there are two different reasons why the limit might exist. All right, well, I said there were three things we needed to think about in this chapter. There's the first, capital rationing. In the next of the lectures on chapter 14, we'll look at the next one, which is replacement.